With the new Income Tax Act of 2025 now in effect, one of the most crucial sections for any business or professional is, without a doubt, Section 26. It's what defines your taxable profit. Getting this right is foundational. So today, we're going to break it down piece by piece. Let's dive in. So, let's imagine a scenario. Your client is thrilled because they've just landed a big government grant. In the very same week, a supplier that they've owed money to for years suddenly writes off the debt completely. Naturally, they turn to you and ask, so, all this extra cash, is it all considered taxable business income? Well, that is exactly the kind of question Section 26 helps us answer. In this explainer, we're going deep into Section 26 of the new Act. Now, this is what we call the charging section. It's basically the legal provision that officially pulls different types of business income into the tax net. And trust me, getting this part right is the most critical first step in calculating profits and gains correctly. Here's how we'll break it down. We'll start by decoding the core of Section 26 itself. Then we'll look at the full scope of what's considered taxable income. After that, we'll run through a practical case study, cover some essential compliance tips to avoid common mistakes, and finally, we'll wrap up with the key takeaways you really need to remember.
All right, let's get started with the absolute foundation, the pillar that every single business income calculation is built on.
Okay, so here it is, the core legal authority, Section 26, subsection 1. You can think of it as the first rule in the playbook. It basically says that any income listed in the next subsection must be taxed under the PGBP head. It's not optional, it's the law. This one sentence really sets the entire framework.
A really simple way to think about it is like an entry gate. For any money coming in to be considered business income, it has to pass through the gates of Section 26 first. If it doesn't qualify here, sure, it might get taxed under another head, like income from other sources, but it won't be PGBP. And this classification is absolutely vital for applying all the other business deductions and provisions correctly.
So now that we understand the concept of the entry gate, let's take a closer look at what exactly gets allowed through. All the specifics are laid out right there in Section 26, subsection 2.
First up, we have the most obvious ones. Clause A covers the profits and gains from your regular, day-to-day business or professional activities. This is your core operational income. Clause G is also pretty straightforward. It specifically pulls in any salary, bonus, commission, or interest a partner gets from their firm, making sure it's taxed as their business income.
Okay, now let's get into some of the less common but equally important situations. Clause B deals with any compensation you might get if, say, a management agency contract is terminated. And Clause D specifies that any income a trade or professional association earns from providing specific services to its members, that's also considered PGBP.
When it comes to government incentives for exporters, the Act is crystal clear. Clause E explicitly ropes in all sorts of export support. This means profits you make from selling an import license, receiving a duty drawback, or getting cash assistance. All of it is specifically included. The law makes sure these benefits are taxed as part of the business's profits.
And here is where the law casts an incredibly wide net. Clause F says that any benefit or perquisite you get from your business is taxable, even if it isn't in cash. Now, why is that? It's because the law wants to tax the true economic value a business receives. So think about a supplier giving you free software, or maybe some valuable services, or even a trip. The monetary value of that benefit is treated as business income. This is a really crucial and honestly an often overlooked area.
Now, let's talk about something called deemed profits. This is where the law says, hey, we're going to treat this as a profit, even if it doesn't quite look like one. Imagine you claimed a tax deduction for an expense in a previous year, but you never actually paid it. Then, later on, your creditor waives that debt. Well, Section 38 says that the waived amount becomes your profit in the year it's written off. The logic here is simple. You can't get a tax benefit for an expense you ultimately never had to pay.
Okay, so theory is one thing, right? But seeing how all these different types of income, from your normal sales to perquisites to deemed profits, are treated in the real world is where it all starts to click. Let's walk through an example together.
So let's consider a company. We'll call them ABC Private Limited for the tax year 26-27. As you can see, they have 5 different kinds of receipts. Their standard revenue from sales, a duty drawback they received, a loan waiver from a creditor, some interest from a bank FD, and the value of some free software they got from a supplier.
Okay, so how do we classify these?
Revenue from sales, that's your bread and butter, classic PGBP. The duty drawback, that's an export incentive, so it falls right under PGB. The loan waiver, remember what we just talked about? That's a deemed profit under Section 38, so it's also PGBP. And the free software, that's a perquisite, so yep, PGBP as well. But look at the bank interest. This is the key distinction. Because it's passive investment income and not really generated from core business operations, it gets taxed under income from other sources, not PGBP.
So we know the what, but what about the how? Applying the law is one thing, but complying with it is a whole other ballgame. Let's talk about the practical side of compliance and some common errors you'll want to avoid under the new 2025 Act. One of the most welcome simplifications in the 2025 Act is this change in terminology. Gone are the days of the confusing previous year and assessment year. Now we just have a single unified tax year. So under the old Act, income earned in one financial year was assessed in the next one. Under the 2025 Act, it's simple. The year you earn the income is the same year it's assessed. Income from the financial year 2026-27 is simply for the tax year 2026-27. It's a small change that makes record-keeping and filing so much more straightforward.
To stay compliant, here are 3 essential actions. First, you have to meticulously classify every single receipt. Get it right from the start. Second, maintain robust documentation, especially for any non-cash benefits and liability waivers. You need to be able to justify their valuation. And third, if your turnover means you need a tax audit under Section 63, just remember that the new audit report is Form No. 26, and it has to be filed on time.
Let's talk about the most common traps people fall into. Please always classify non-monetary benefits. Don't make the mistake of ignoring them just because no cash changed hands. Definitely treat liability waivers as deemed profit. Don't forget to offer them up for tax. And critically, separate your business income from other income sources like investments. Don't mix them up because it really can affect your entire tax computation.
Whew, we've covered a lot of ground. So let's just take a moment and boil all of this down to the most essential takeaways.
First and foremost, always remember that Section 26 is the gatekeeper. It is the charging section and the non-negotiable starting point for calculating any income under the head PGBP. Everything starts here. Second, you have to appreciate its wide scope. It goes so much further than just sales revenue. It's deliberately designed to include perquisites, government incentives, and deemed profits, all to make sure that all forms of value a business gets are brought into the tax net.
And finally, number 3, correct classification is not just some academic exercise, it is a practical necessity. I can't stress this enough. Getting it wrong can lead to incorrect tax payments, interest, penalties, and long, drawn-out disputes with the tax authorities. Precision really is your best defense.
And I'll leave you with a final thought to mull over. As we move deeper into the digital age, with new business models built on data, digital goods, and online collaborations, how do you think the interpretation of a benefit or perquisite is going to evolve? What new forms of value will this clause need to cover in the future? It's a fascinating question, and one that will probably shape tax discussions for years to come. Thank you for watching. Please like, subscribe, and share.